We're all set.
I'd like to call a meeting to order of the Food Service Committee and approval of the minutes from way back in October 13th, 2021, which I looked over and they are fine. And motion to accept. So moved.
Second.
All in favor? Aye. Thank you very
Aye.
much. There are any public comments? Is Steve Browning here? Steve is the president of the Food Service Union. He's the union president. We will then go ahead. There are 3 pensions. Jerry, are you there? Hello, Jerry? Well, then how about if we postpone this meeting until later when Jerry's here to go over the pensions? It's quite interesting. There were 3 pensions and the last time we even had a single
Here.
one. Nearly. Is that you,
Frank?
Jerry?
Yes,
Oh,
I'm here. Can you hear me? Yes.
you
So
like
my
to go over-
apologies. Brian.
No, no problem.
Jerry,
It's excellent. I'm happy that you're here.
Yes, Jerry is in the house. Okay. Is Steve Browning on this meeting?
I do not see Steve here. Steve? He's not here.
Yeah,
Uh,
definitely.
You're, it's hard to hear you or understand what you're saying. Jerry? Jerry, I think we're having some audio difficulties. Not really. For everybody right now, we're doing the Food Service Committee. There's 3 pensions. We're trying to go over them with Jerry. Not really, no. So why don't we table this for now and we'll come back to it after the regular meeting, but also be aware that your audio might not be, you'll have to improve your audio in order to go through the pensions that are in the regular meeting. Okay. Charlie, you want to move to table to, we're going
Yeah, I
to
move that
postpone
we
this.
table the remainder of the pension board, the food services meeting until we can solve the audio problem.
Excellent. Second, all in favor? Aye.
Aye.
Great. So now it is officially exactly 6 o'clock. So I am going to call the regular pension board meeting to order. And seek approval of the minutes from the last meeting of June 8th.
Check and see if they spelled Chitsumi's name correctly. I don't think so, but I'm not positive. Is she here?
Chitsume is here.
Did they spell your name correctly?
No, it doesn't, it's all wrong. It's
Okay.
Citsamay. Thank you.
Okay.
If that could be corrected, please. And with that, aside from that correction, is there a motion to accept the minutes?
I move we accept the minutes.
Is second,
I'll second that.
all in favor?
Aye.
Opposed? No? Excellent. Are there any public comments? If there are no public comments, we're going to go hopefully to the approval of the pension applications. If we can, Jerry, if you can do that, if your audio is up now.
No, still not
Um,
working.
Okay, we're gonna move on to the International Equity Management Search. If, Britt, you're ready for that?
We are. Good evening, everyone. Nice
Good
to
evening.
see you all. Hope you had a great summer.
We did.
So I'm joined by Lauren Matthias, who's a member of our Global Manager Research Group, who has been instrumental in getting to where we are today. So at our last meeting, if you recall, in June, we heard from Artisan, and the board decided to see if there are any other candidates out there that might be attractive. So Callan initiated our search process, and I'm just going to share my screen to give a quick overview of how we got, oops, wrong one, sorry. Can everyone see?
Yep.
My screen? Great. So just as background for those of you who may have not been on the board when we've done a search, essentially our process is fully customized to each client. So at the start, we create a profile really describing what the Norwalk pension system is, what we're doing, what we're looking for, and a candidate profile. So in this case, we're really looking for an international growth equity manager that is benchmarked to the EFA Growth Index or has the characteristics of a growth manager and is favorable against peers, et cetera. So that's really the starting point. And from there, Lauren and her team really dig into the universe of candidates and try to narrow down a reasonable list that we can use. And there is a qualitative overlay to that assessment as well. So Lauren and I have had a number of discussions along with other members of our international equity research team over the last few months. And we narrowed it down to about 12 candidates to be reviewed by our manager search committee. And essentially our manager search committee is about a dozen senior consultants from across the firm at Callan who review all manager searches before they go to the client and ensure that you receive Callan's best thinking and leverage all of the experience that we have across the firm in the short list of semi-finalist candidates that we're going to review today. So I'll pause there, see if there are any questions about the process. Essentially where we are today is Lauren's going to walk us through some of the merits and considerations for the 5 or 6 candidates that we have in this analysis. And ultimately, I think the goal would be to try and get down to 2 or 3 finalists to bring in for interviews either next month or in November.
Hey, Brett, how big was the universe that you started with?
Lauren, do you want to maybe touch on that and then we can dive in?
Yeah, sure. Happy to. So we save you from the painstaking process of narrowing the list, but it is about hundreds of strategies, to be honest with you. And then we narrow it to somewhere around 30 to 35 that might have the vehicle considerations that are required, the characteristics that we're looking for. And then from there, we narrowed it to the 12 and then the 5 today.
Okay, thank you for doing that.
It's our job.
Okay.
So maybe with that, we can dive in and let Lauren kind of describe the key characteristics of the semi-finalist candidates that we have in our analysis. And please feel free to ask questions along the way. And we certainly hope this is as interactive as possible.
Yeah, absolutely. And Brett, I can see that you're sharing the screen. Is that the full book? Do you want to kind of go to specific pages for me, or should I take charge of the sharing?
Yeah, why don't I turn it over to you? It'd probably be
Okay.
more seamless.
Sure. Well, while I pull that up, just to reiterate what Britt said, we We're looking for a manager who has true growth characteristics. I understand one of the challenges with Artisan, who we are also familiar with, is their ability to kind of vary in how they view growth. And while that may be favorable over the long term, there are periods where they're going to not look like their growth peers. So when we narrowed the list, we were really targeting those organizations and teams and processes that were really focused on growth companies and will give you that growth exposure that's necessary really to pair with Silchester, who is a true value investor. And so what I can do is walk through the 5 candidates that we have narrowed the list to. I'll give you a brief overview of each organization, just to confirm you can see my screen. Yeah, okay.
Yes.
Great. So I'll give you a brief overview of each organization, and then I can kind of give you some quick synopsis of the merits and considerations of each firm. And then we can have a dialogue. Happy to take questions throughout the presentation. So please, jump in. If I see someone come off mute, I'll try to make space for questions and for feedback. The book that we have has a starting section that provides a quick summary. So this is kind of the section of which I'll just share with you a little bit about each organization. Everything's in alphabetical order, so I'm just going to start with Capital Group. So Capital Group, you might be familiar with, one of the largest asset managers in the United States. They're privately owned by current employees as well as some retired employees. Capital Group's kind of main differentiator is really how they construct portfolios. So Capital Group portfolios are managed by portfolio manager sleeves. So in the case of this international equity strategy, it's managed by 5 different portfolio managers. They're given a subset of the assets of the strategy and allowed to invest how they see fit. Now, that being said, they do follow a broad kind of approach in how they try to select their securities for the portfolio. It's all fundamental bottom-up research conducted by both the portfolio managers as well as the broad central research group at Capital Group, which is over 110 research analysts. But each portfolio manager provides a little bit of a differentiation to the process. So in the case of Capital Group, these 5 portfolio managers, some are more focused on price to earnings or price to book. Some are more concentrated, some like smaller market cap securities. Some are more focused on value. But overall, when you construct the portfolio with these 5 portfolio managers, at the end of the day, they're looking for long-term capital appreciation. And that's what gives the fund overall that growth posture that we're looking for. It's a diversified portfolio of over 160 to 200 names, relatively modest turnover, and emerging markets exposure that stays below 10%. That is an important factor here. We are looking for a developed focused manager, but with some ability to invest in emerging markets. So you'll hear me mention kind of what the range of emerging markets exposure is for each strategy, but these final 5 candidates are going to have very moderate exposure in order to give that developed markets approach.
Hi, Lauren. I have
Yeah.
this Rich Baskin. I have a quick question. How much overlap is there in names, or are the 5 sleeves given a distinct universe?
Yeah, so there is overlap in names. It's not as much as you would think. So some portfolio managers, for example, this Akira Horiguchi, she only has 6 companies in common with the rest of the group, while as Michael Cohen, who's one of the portfolio coordinators, might have 12 overlapping with the group. So it ranges, but generally speaking, they are trying to find portfolio managers that offer something differentiated to the portfolio to not have too much overlap. So it ranges from 6 to 12 holdings across the 5.
Some of the MSCI indexes on a world basis can be very concentrated. And so I guess they would have to divide it up like that. Is that how it works?
In terms of how they decide which portfolio manager has which amount of the strategy?
or what, for example, Taiwan Semiconductor is a, well, that's an emerging market, bad example. Come up with some heavily weighted name in the index. So is that just one person's coverage list? Because let's say the top 10 names are 25% of the index.
Right. So their universe is the IFA index. They're all paid based on how well they do versus that index. So they're all motivated to beat that index while still representing the index, if that makes sense, right? So
No, it does.
yeah,
Completely.
so if investing, a very large portion of the fund in one security is how they see that they'll add value, then that certainly can be an option, but that's the benefit of having the multi-PM approach. I'll also say that, to be a portfolio manager at Capital Group takes years. So they start as analysts basically, and they grow up in the organization. Then they're given the opportunity to contribute to the research portfolio, which I should have mentioned is also a portion of this strategy. Once they've proven themselves within the research portfolio, then they're given the role of a PMX, which is basically they're basically managing a paper portfolio. And then eventually they get to become a portfolio manager in the sleeve. So, these portfolio managers are managing in a prudent way to be able to beat the index and to show that they can outperform the index over time.
And Rich, to your point, I think we see with Capital Group and their US funds, some of the big bets and single names in more concentrated indices like, the Russell 1000 growth or S&P 500, where 3 or 4 PMs might have a big weight on Apple or Tesla. And when you combine it all, it really can become a problem and a big bet at the overall portfolio level. I think the EVA index is much more diversified than some of those. And you can see by the holdings, 160 to 210 names, that it is extremely diversified.
Yeah, and I guess another figure that might be useful is if you look at the top 10 holdings for each of the portfolio managers, about half of them don't overlap with each other. So there's really not kind of an over concentration in any one area.
Yeah, it just it can be an issue, particularly for some concentrated indexes.
Mm-hmm.
Okay, thank you.
Yeah, absolutely. Thanks for the question. So some of the positives about this strategy is really its ability to perform well in growth-led markets. There's a performance section here at the end of the book that we can dig into as needed, but really they kind of apply that that growth orientation that we're looking for. And additionally, because of the diversification, they tend to have kind of a smoother ride. So better risk return characteristics if you think about kind of overall volatility versus the performance that you're getting from the strategy. So those are some of the positives. The one challenge with a portfolio like this is really transparency. So we mentioned the portfolio manager sleeves. We are able to see, like I mentioned, holdings, various characteristics, but they don't share the exact performance of every portfolio manager. We're really only able to view the aggregate performance of the portfolio. So that's something that in the past has been a challenge with this portfolio, but over the years, Capital Group has become more transparent in what they've been able to share. And so we are able to see those characteristics, just not the performance. Any additional questions about Capital Group? Okay. Oh, James?
No,
You're off
good,
mute.
thanks.
Okay. Okay, then we'll move on to Fidelity. So Fidelity is another large asset manager you may also be familiar with. They're also privately owned. The strategy that we're looking at here is the Fidelity Diversified International Strategy. Typical of most Fidelity strategies, it's led by one sole portfolio manager, Bill Bauer. And then he's supported by Fidelity's Central Research Analyst Group with over 150 analysts. Bill Bauer has been on the strategy since 2001, so incredibly impressive tenure here on this portfolio. He's been at the firm since 1994. Bill Bauer's approach is really to identify firms with better profitability, better earnings growth, better returns on capital, ultimately with the belief that earnings drives performance securities. He leans heavily on the analyst team while he does his own research. 95% of his holdings are covered by the analyst group, so he does utilize their research extensively. He really wants to understand management teams, confirm that they really are acting like shareholders, and really kind of paying attention to shareholders and their process. Characteristics of the portfolio that we like here is, higher quality. So thinking about return on equity as a measure of quality, higher EPS growth. And so you're getting that quality growth characteristic. Some things to note here is the emerging markets exposure can be relatively high. The prospectus will say 20%. Bill would say 15% is really in practice kind of the maximum, but it has increased slightly over the years. It used to be below 10%, but it's increased to about 15. So it may stay there if he sees opportunities there. It's also more multi-cap in nature, so that he can invest in more mid-cap securities as well as large cap securities. So that's something that to note, that's a differentiator in this strategy. It's very diversified, 200 to 300 stocks. So that gives it that kind of more smooth kind of performance pattern with that diversification. Some considerations for this strategy really is while we're looking for a growth mandate here, the index is the EFA index. And in an attempt to be kind of diversified, there will be an overweight to financials, a pretty persistent one, given the EFA index bogey. And so that's something to keep in mind, as financials typically, add some more value exposure to the portfolio and, may not contribute to as much growth characteristics over time. It can oscillate a bit, which was a characteristic that we saw of Artisan that was not as favorable. There can also be some regional overweights. I mentioned emerging markets, but also to North America as well. So some of the variability in style is something that to keep in mind here.
When we're,
Tom,
go ahead, Frank.
I was just going to ask, what do you consider within this portfolio mid-size? How large is that?
Good question. I can get those figures for you exactly, but I'm thinking somewhere kind of between the 20 billion range probably would be more kind of a mid cap, but I would need to get the figures to specifically be able to address that for you. There's a page here that we like to use that kind of maps it out so you can see versus peers in the index, which is one of the most relevant things. Let me just scroll that down to that for you. But you can see the distinction on this page here. So Fidelity is the one here in the teal. So you can see that from a mega large mid cap standpoint that they're slightly smaller than some of the other candidates here at the top that are exclusively large cap. It's not a significant difference, but when we're trying to pull apart differentiating factors of these final 5 candidates, it was relevant to mention.
Yeah, one of my issues with Artisan was that, here they were non-US developed market growth portfolio manager, and all their outperformance was coming from North America. What's your opinion of Fidelity here? I think we have an the way I view the allocation is we have U.S. managers that are going to pursue the U.S. growth opportunities, and my assumption is they're much closer to it than someone who has to focus on the non-U.S. opportunities. What's your opinion of where Fidelity falls in you said they can have some North America. If it's is that, how much has that contributed to their relative performance in the last number of years.
Yeah, it is a consideration here. And while they certainly were, attractive out of the 12 candidates that we presented to our search committee, I think thinking about kind of the specifics as we try to narrow the list even further for finalist interviews, I think it is a characteristic that is not as favorable as some of the other candidates here. And so that's why I brought it to your attention. There are other candidates. If you look at some of the pages we have here, I really like because they really give you a sense of where the strategies plot versus the index. And so, here it shows some of the overweight to financials, as I mentioned, in the red. So this is looking at the relative sector weights versus the IFA growth. So anything above the 0 is going to be an overweight to that sector, and anything below it is going to be an underweight. And so apologies if you can't see the table there. Okay, so then the red is the financial. So, as we're thinking about a strategy that can really give growth exposure, having ones that can add value from stock selection while also keeping that, that growth posture, they tend to be a little bit more aligned with the growth index. And so that's not necessarily the case here with Fidelity. And you can see some of that here with Artisan as well. And you can also see it from the regional basis here on the next slides. So Fidelity with its overweight to emerging markets, as well as North America here.
And Rich, to your point, I think some of the things that we really keyed in on when looking at these candidates and the group as a whole is, one, emerging markets exposure. You have a dedicated emerging markets manager, and that's really how, to your point, how the portfolio is accessing emerging markets. Sector bets, especially financials, Lauren just highlighted. Artisan has a huge bet in European financials, which really has dragged on the portfolio. And third is certainly their North American exposure relative to the benchmark. And to Lauren's point, some of those are quality biases, and Artisan certainly more of a GARPy growth at a reasonable price manager. And as we will walk through the rest of these candidates, I think 2 or 3 will certainly rise to the top, and taking those under consideration in the grand scheme of things.
Lauren, on the previous slide, there was a note that Bauer was a key person risk. What's behind that?
Yeah, thanks for mentioning that. So, one of the pros of Fidelity's approach, and sorry if I'm making anyone sick by going so quickly after this, one of the key aspects of Fidelity's approach is to have these PMs with, complete autonomy and experience, and that definitely is a value add from that standpoint. But on the other side of that, you end up with, one portfolio manager managing the strategy without a clear succession plan. Now, Fidelity has most definitely identified somebody to take over for him when he's ready, but they don't really tell you who that person is. When you talk to Bill and you say, oh, so who's going to take over for you, and you decide to retire, and he said, I know that there's somebody in the wings. I just don't know who that is, but I trust that they will be experienced and be able to kind of hit the ground running. While that might allow him to sleep at night, that's not necessarily my favorite example. And, you'll see with other strategies here, there's just a bit more robust thought process in terms of how to create continuity in some of their portfolios. And so we highlight it as a risk here.
How old is he?
Good question. He started his career in 1994, so we could do some back of the envelope math. But he hasn't mentioned that he wants to retire anytime soon. So I will say that, but it's always a looming consideration.
Okay.
Okay, so moving on to MFS. So MFS is a Boston-based firm owned by Sun Life Financial. Employees do own a portion of the organization. This team is globally based, so it's a 2 portfolio manager structure. Kevin Dewan sits in Singapore and Matt Barrett is in London. The strategy used to be managed by 3 portfolio managers. David Antonelli was the 3rd. He was based in Boston. But after a long and well articulated plan to retire, so he announced his retirement in 2019 and eventually retired in 2021. He is no longer on the team, but we've observed this group ever since his retirement and throughout his announcement, and there's really been no change in the way the portfolio is constructed or the success of the portfolio and its performance. So Kevin and Matthew are supported by a central research team that's also globally based. The process is bottom-up, fundamental, quality growth. They want high quality franchises, so ones that are returning, ones that are performing above the cost of capital on a sustainable basis. One of the key characteristics of this portfolio, I would really say, is quality. They really want that structural, compounding business. They are less interested in speculative growth or any of those high kind of flying growth companies. Their performance pattern reflects that. It's a bit more defensive and much more sustainable. This strategy, so this team manages an international growth platform, basically. Their international growth strategy that includes emerging markets is about 20 billion. This is the strategy that excludes emerging markets per the name. So they do not have any emerging markets exposure. It's fairly diversified, 60 to 100 names, not as much as the other 2 portfolios we looked at, but enough to keep those defensive characteristics in place. Yeah, so performance, when we look at the results, it really does reflect kind of the process. It's very consistent, it protects very well in down markets with that quality orientation. Very steady Eddie is how I would describe this. What else can I tell you? I guess one of the things that I mentioned, they have basically a $22 billion business, but the majority is in the other portfolio. So you'll see here, this product has 2 billion, and the share class vehicle that we're looking at, does not have as much assets as the others. I bring it out as a point to mention. Of course, that didn't deter us from including them. Substantial book of business. It's just the ACWX US strategy just has kind of more interest. We see more ACWX US searches anyway, so I think that really plays into that, and less the skills and the quality of the portfolio.
How concentrated is are the investors in that? Is it, one company has 30 and everyone else has 11, or is it, 5, or, in terms of if somebody leaves, we're not left holding the bag.
Oh, from the portfolio management perspective?
Right.
Yeah.
More in the
yeah.
sense that how much the asset the vehicle has. Are there going to be 10 investors alongside of us, or 50, for example?
Right. So this vehicle has 2 clients, I believe, if I look in our database. So 133 million or so, and the other, whatever the balance of that is, around 8. The strategy itself has a little over 2 billion. So, you would be one of a handful of clients in the specific vehicle, not in the product.
So so I guess one thing to explore is what's the difference between the product and the vehicle. I don't know if you.
So
doesn't need
the
to happen
products,
now.
yeah. Oh yeah, no, that's okay. I can tell you that. I mean, so the other assets are invested in separately managed accounts. So the product itself has 2.3 billion, 41 is in the commingled vehicle, and the remaining 2.2, and change is going to be in separate accounts.
But that 2.3 and change is following the same strategy.
Absolutely.
Okay. All right. Thank you.
Mm-hmm.
Thank you.
Yeah.
Are there fee differences between those 2 vehicles? The separate accounts and the Presumably the other one's a collective trust or something?
Yeah. Typically, the separate account fee is going to be slightly lower than the CIT fee, but that would depend on the mandate size as well. But CITs, are, very favorable fee wise. And I'm on that page now, so you can kind of see those, and we compared them to your incumbent manager as well.
Yeah, and one thing, Jim, for this asset size and Norwalk in general, the custodian fees for an international separately managed account would certainly be significantly higher and
Yep.
gets significantly more complicated, as you can imagine. Trading individual securities in various countries gets complicated quickly. So we definitely would recommend a commingled vehicle for both the custody reasons as well as the size of the assets looking to be invested here.
Yep. Lauren, I don't want to hop around if you're going to get to this slide later, but I notice here Fidelity does sec lending. Isn't that contrary to our guidance? Frank or Brett?
Yeah, I think I'd have to review the IPS. In general, I think the IPS states that you're not in favor of sec lending, but that is in separately managed accounts that you have. You really can't control anything that happens in the commingled vehicles, even
Okay.
if that is your desire. And I think we will touch on this once we get through the candidates.
Yep, okay.
Any other questions about MFS? Okay. Yeah, and I guess one thing I'd mention, since we did talk about kind of succession planning for Fidelity for MFS, what they'll do is they'll add a portfolio manager to the team and provide a kind of a long runway of time with that third PM to work with the two PMs before, an assumed another PM was going to retire. So it's really this nice kind of overlapping process that they have shown across their international strategies, across their US strategies. It's really a firm-wide process of making sure that the right people are in place in advance of any of those changes. Okay. Moving on to Schroeder. So Schroeder's is a publicly traded company. It does have some family ownership as well as some employee ownership, but a large portion is publicly held. This team is based in London. It's managed by two portfolio managers, Simon Weber and James Gotchery. They manage an international alpha strategy, which is the one that we're looking at here, and they also manage an international equity strategy. The team is supported by 11 sector analysts. This is a bottom-up fundamental, quality growth process. You're probably used to me saying that so far, but what differentiates them here is they're really looking for growth gaps, or what they kind of refer to as unrecognized future earnings growth or unappreciated by the market. So they're looking for, basically accelerating growth companies that the market, isn't viewing as that. But when they construct the portfolio, they do it a bit more thoughtfully, so they don't end up with these kind of, fast, growing or high growing companies. They balance it between what they call strategic growth and more opportunistic growth. So if you picture kind of a company where the market is expecting, 10% growth, they'll invest in the company that over time may get to 12% growth. That's a strategic growth opportunity. Whereas the more opportunistic ones are the ones that tend to oscillate over time, a bit more cyclical, where something's happened to them, but there's a catalyst that'll kind of bring them to that next level of growth that they're looking for. So by balancing these two types of growth, they end up with a more, balanced portfolio that has kind of more quality growth characteristics. It is a bit more concentrated, around 50 names, and turnover is pretty modest, around kind of 50 to 60%. I think one of the things that we like about this portfolio is really kind of the tenure of the portfolio managers. They've been on the strategy since its inception in 2003. one of the parts of their construction process also really takes into consideration factor risk and utilizes some of these tools to be able to balance the portfolio a bit. But one of the things that is a part of that process of balancing risk is they do look at it versus the EFA index. So it can end up, again, kind of having some of those over and underweights versus the growth index that kind of bring its growth characteristics a little bit down. It kind of dampens kind of the growth flavor of the portfolio. So I'll take you back to the pages that we were looking at before so that you can kind of see this in practice. But it tends to have a little bit of an overweight to financials here. Once again, kind of, maybe less so than Fidelity, but you can see kind of the range of exposures here, is much wider than, let's say, an MFS here. And that's just kind of showing us that their over and underweights to various sectors are going to be, a bit more varied than other candidates here in the book as a result of that, kind of risk evaluation process versus the broad index as opposed to the growth index.
So that's the red is the amount of overweight, right?
Yeah. So red is their financials overweight. And so every color you see here will be a different sector.
Financials and okay. So the financials are, let's say 17%. This looks like they're about 5% overweighted. So they'd be up around 22% financials. Is that the way I'm reading this? Because it's a stacked bar chart. Am I reading that right?
Yes, you are exactly reading that right. Yep.
Boy, it's hard to get that much growth out of financials.
Yeah, it's interesting. And I think it really has more to do with the fact that they're balancing it to the EFA index. So there's a couple sectors that vary pretty widely when you think about the style indexes. When you're looking at EFA growth, financials is going to be one that's going to be, a bit less in the growth index than it is in the EFA index. And so that is really kind of leading, I think, to that dispersion. When you talk to them, and even when you talk to Fidelity, they don't necessarily, call out financials as necessarily a source of alpha for them or a key criteria. But again, having that risk kind of construction approach to the broad benchmark is just going to have this be an out way of that, input, I guess, so to speak.
Thank you.
Does anyone else have questions about Schroeder? No? Okay. I'll cruise back real quick to our summary so people can kind of read as I chat about it. Okay, so Walter Scott, this is the last firm on our list. This is a firm that is owned by the Bank of New York Mellon. They're based in Edinburgh, Scotland. The investment team is 18 regional analyst specialists, and they're supported by an investment executive of 5 people. The regional specialists are in regions based on EMEA, Asia Pacific, and Americas. And then they submit basically their best ideas to the investment executive, where they weigh and kind of compare, contrast ideas. And then ultimately the investment executive makes those final decisions in the portfolio. Another bottom-up fundamental manager here, they're looking for high quality growth. And really kind of their differentiator is really this focus on sustainable wealth creation. Think of it more as kind of an absolute return approach. Their turnover is incredibly low. They're trying to find those long-term winners. In fact, 75% of their portfolio holdings have been held for over 5 years. So they really do kind of practice what they preach. They have a process they go by, which they call the 7 Sisters analysis. It includes kind of everything you would think of, but more specifically, they're looking at, the company and the history and how it's been managed. They evaluate ESG factors. They look at the marketplace that each company is in, whether it's a cyclical market or a structural growing market. What's the size of the market? How does each company fare within that market? What are the competitors? What's the market share? They look at the financial profile with a specific kind of focus on cash and debt. That gives them that kind of quality posture. They need to know management's track record and how well they've managed the business over time. And then finally, they do consider valuation as well. It's a kind of a moderately concentrated portfolio between 50 and 60 names. Pretty low EM exposure, below 10% over its history. And just, an overall kind of quality growth characteristics. And this kind of absolute return wealth creation approach creates a bit of a lower beta in the strategy. So you'll see really good downside protection and really good performance when growth is in favor, kind of with that lower beta approach. What we like about this strategy is really this team-driven process. It really helps kind of mitigate any risk to any changes to the team. But I would say they've had very few changes. When people join Walter Scott, they just don't leave. I actually used to live in London for a few years, and I visited them every year in Edinburgh, and nothing changed. The only thing that changed over the time that I was meeting with them is they ended up getting a new office, but it was just right next door in this other Victorian that they just kind of had redone. So same people, same team, same process, slow tweaks and improvements over time, but really a dependable manager and strategy.
Lauren, do they have ranges on the investments, the portfolio investments in the different regions, EMA, APAC, and Americas, or is it the best ideas come to the top and they take whatever without regard for region?
Yeah, it's really the best ideas. The idea behind the regions is to get kind of the professionals to become kind of experts in that space. But one of the really interesting things that they'll do is, they build people from the bottom up. So they'll have analysts they'll join a specific regional team. They'll work with the regional team. They'll mentor that specialist. And then that individual will move to a different region and then start to kind of indoctrinate into that other region and then learn more about that region. So you'll see kind of a transition of professionals kind of among the regions to be able to kind of over time get that kind of holistic global approach. I should have mentioned that in addition to managing international portfolios, they also manage global portfolios as well as an emerging markets portfolio. So they really are kind of, trying to be global specialists and over time gaining expertise in those specific regions.
And I would just add, Jim, the interesting part, Lauren, if you go to page 32, to show the relative region exposure, they were probably the tightest to the EFA growth benchmark of all the candidates we're showing, even though their process is so differentiated. You can see they're underweight to Europe, but really not making huge out of benchmark sector bets.
Yeah, pretty tight band. Yeah.
Yeah, which is interesting because you would think the opposite given their process and how they go about thinking about things.
Okay.
Okay, so we've talked a little bit about every manager. We haven't really looked much at kind of the book, but maybe I'll just kind of highlight a few pages that kind of is basically kind of the result of all the process and details that I've explained here. This is the combined Z-score. I don't know how familiar you are with this measure, but basically it describes at a high level the growthiness or valuiness of a portfolio. So you'll see the EFA growth index here as kind of the most growthy as a positive 0.84 as its final score. This width of the bar will tell you how much that's ranged over time. And then it kind of, follows from there. So, for some perspective, you can see Artisan, how much their style has ranged by the width of this bar here. And so that kind of, that, you felt that and you've lived that. We are definitely looking for a manager that's more solidly growth to, again, be able to pair with Silchester. This is the stability score. Again, I'm not sure how much you've talked about this at all, but it's basically measures the difference between a more defensive portfolio and a more dynamic portfolio. So things that's looking at to measure this is like total return volatility, debt to equity ratio, earnings volatility, return on assets, things that kind of measure quality and stability. And so you can see, pretty aligned with processes as I've described, those more heavily quality growth strategies like Walter Scott and MFS are going to be up here with higher stability. And really that just means persistent characteristics and kind of a more of defensive posture and growth. And, that was the weighted median market cap. This is the number of holdings. The issue diversification basically just says how much of the portfolio is in the, the half of the market value. How many holdings does that make up? So that just shows you kind of how diversified or how concentrated each manager is. We've already kind of looked at the country weights in the other page, and then this is the performance pages. I guess what I would point out here is at the end of the day, all 5 of these managers have done incredibly well. We wouldn't have brought them to your attention if that wasn't the case. So, that's a positive. But, I guess thinking about, how do they differ from each other? I would say it's probably easier to see kind of on a calendar year basis. So when you think about, periods in down markets, like for example, this year so far, a strategy with a lot of quality orientation like an MFS is going to hold up much better in a down market that we've experienced. And you can see it kind of show up here. Fortunately, many of these managers have done well over this period. Of course, the first 2 quarters of this year have been incredibly diverse. I mean, the first quarter favored value, energy primarily. And the second quarter, we did see a bit of a shift where some more quality characteristics were in favor as we've kind of entered a more kind of recessionary fear kind of marketplace. And so with that quality orientation, they're going to do quite well.
Lauren, should we highlight the up market and down market capture too, please?
Yeah, definitely. Okay, so that is here. I talked about a little bit in my conversation of each manager, but I highlighted it with Walter Scott because it is pretty significant here in terms of their down capture. You can see that they have the best down capture of the rest. So they're really protecting capital when there are those down markets. And then this is a correlation chart. So this is really just measuring the excess return correlation of the growth managers versus your value manager. We did it versus the EFA index so that you could really kind of see the real performance differentiation. And so all of the managers that we're showing you here today are going to zig when Silchester is zagging. And so that's really what we're looking for here. The following charts are really kind of risk reward. Generally speaking, it's hard to kind of put this in perspective because all of these are pretty good when it comes to kind of a balance of volatility and returns. But certainly, there's a couple of standouts, Schroeder being one of them. Again, with some of the differences in sector and regional weights, you're going to get some of that. With some of the concentration, you're going to get a bit more volatility. So there's various reasons for all of these, but I think what stands out to me is really kind of the lower volatility approaches with MFS and Walter Scott end up over here without sacrificing any of the return here. So.
Yeah, I mean, you look at that, it's Walter Scott, MFS and Schroeder. And, looks like you are getting that with MFS and Walter Scott, you still have the return with less volatility versus Schroeder. You get slightly higher return, slightly higher volatility, but the others are lower return and higher vol. So you're not getting paid for the risk you're taking.
What's the time horizon on this chart? There we go.
5 years.
Yeah.
And just so everyone's aware that the crosshair is the median peer in the peer group. I believe, Lauren, if I'm speaking out of turn, please let me know. And
no, you got it. And the ellipse is kind of
broad peer group.
Yeah.
And there's a 10-year chart also, right?
Yeah, so if we keep going, we can look at longer time periods. So this is excess return versus tracking error. So
Right.
that's going to be versus the index versus absolute volatility. There's measures here, and then we can look at it for a longer time frame. Yeah.
Right, right.
I mean, correct me if I'm wrong, but as long as there's nothing sort of concern structurally with the institution, how they run their processes, aren't these slides the most critical?
Yeah, absolutely. The amount of risk you're taking and the amount of return you're getting, absolutely. These are very important. We definitely take them into consideration. We try to balance them with those qualitative, aspects of the research that we do on the ground, knowing the teams and their processes and whether they're repeatable or not. Certainly 10 years would lead you to believe that process will continue going forward. But, without knowing any of the background, it's hard to know that, it's hard to depend on these as well. So.
Maybe with that, Lauren, if we can jump to the fee summary slide and just highlight the pricing and the vehicles for the candidates, that'd be great.
Right. So we did have this slide a bit earlier, but here it kind of lays out all of the different vehicles that we have under consideration here. One of the ways that we narrowed the group was really a focus on commingled vehicle, and that could really be a mutual fund or a CIT. Mutual funds tend to be more expensive, so there are more CITs on this page than mutual funds. Nothing, really to note too much here, except for what you mentioned about Fidelity and the securities lending. I guess some other pieces to point out. Most of these are daily valued vehicles, except Walter Scott, which is weekly. And it is a bit more expensive than the peers in the group, although still much cheaper than kind of the fee for Artisan. So it's still within range.
So a CIT versus commingled, what's the difference there?
Yeah, so CITs can work for retirement assets. Usually, they list commingled here, but we've made sure that they can work for your pension plan. Other commingled vehicles are specific for endowments, foundations, things like that. But these vehicles are specific for pension assets.
Okay.
I noticed in some of the charts you had Schroeder and Schroeder supplemental because of the history of the vehicle. Is that something we should be concerned about or take special note of?
No, thank you for bringing that up. Yeah, apologies for that. No, because the vehicles are really managed the same as the kind of aggregate composite, which is what we're showing as the supplemental. It's just a different way to kind of bundle it. So we will show the supplemental because we have a lot of faith that the CIT itself over the long term will mirror or be very close to that of the composite.
Is there anything about redemptions that we should know?
Yeah, so you can see MFS, they list here, there is an exit fee of 4 basis points. That's probably in place to protect the investors, given the 41 million in assets. We can confirm with them if that would remain in perpetuity as assets increase in the vehicle, but typically there is some sort of entry exit fee to protect the current investors if the asset base isn't substantial enough to kind of manage that.
Has that vehicle been around a long time, or is that fairly new?
Yeah, let me see. We usually do include a slide that shows that. Let me just get you to that. So, okay, well, so their CITs incepted in 2009. I'd have to confirm whether the class 2 is something that's more recent, which I can absolutely do for you. But the CIT itself has been around since then.
Mm-hmm. But there's only a few clients in it, right? You said?
That's right.
Yeah.
Yeah.
And we would get the same protection as those other clients?
Yes.
There, okay. I don't want to be the only one with the 4%.
Yeah, no, that's what,
Everybody else
yeah.
gets-
Yeah, I know that's the idea, is protect current clients. And yeah,
Could you go back to the risk return charts? I just,
Yeah.
Was it,
so we'll look at the 10-year.
yeah,
So this one is the overall volatility, and then we do have
Yeah.
or I guess that we don't have the excess return, but I could go to that too if you'd want,
Yeah.
but
okay. Okay, yep, thanks. So it's Walter Scott and MFS that are in the nice quadrant. Okay.
Any other questions? Or anything else that you would like to go over?
No, I guess we'd love to hear the board's reaction and opinion in terms of potential interviews going forward and trying to narrow the list down a little further for next steps.
Can you go back to the fee schedule now? I mean, these are the two most important things, I think, in my mind, the fees and the risk return. So assuming we got stable organizations here. Okay. I mean, so my view, aside from the fees, I like MFS and Walter Scott on the risk return scale, but I like Schroeder's fees.
Yeah, I would echo that. I mean, the one thing that's interesting, that Schroeder hasn't been hurt by having the overweight in financials. And so that's one thing that's a positive for me.
But you're getting that higher volatility.
Yeah, but you get, yeah, true. They have Schroeder has a limited but not too much exposure to North America. I like that. Walter Scott has a little or none. MFS. They all look about the same, and so I think that is, if we're looking for something to go off of away from that. What's the correlation with Silchester? Could you put that up again, please?
Yeah, they're all negatively correlated with Silchester to varying amounts.
So count Fidelity, MFS, 50-50, 54. 56 with Walter Scott. Walter Scott with
So you can see, I think
Schroeder with
Artisan and Silchester are negatively correlated by negative 0.51, and I'd say MFS, Schroeder, and Walter Scott are right in that same ballpark, and then you can see Capital Group and Fidelity even less correlated.
What about if we select 3 to be interviewed? Is that reasonable?
Absolutely.
Yes.
So what about, is there anyone who feels strongly that we do not feel that they would be a good fit, and to eliminate them? We could do this by process of elimination. Is there anyone, Rich, that you really would be uncomfortable with?
Well, I don't know whether it's the right word is uncomfortable with or not, but for me, I think the first one out is Fidelity. I think a little bit too much financial exposure, a little bit too much on North America. So that'd be my first one out.
What do you think of that, Charlie?
I'd say the same thing. I'd say Fidelity would be my first one out as well.
Jim?
Yep, I'd agree with that. I'm fine with that.
Okay, Fidelity's out. Okay, next up is Jim, which one would you, the remaining ones?
I guess I'd probably next go to Capital Group.
Yeah, I would agree with that too.
I wouldn't
How about you,
dispute
Chuck?
it. I wouldn't dispute Capital Group. MFS, the only negative I saw was the exit fee. But, yeah, I'd say like eliminate Capital Group is okay. And interview the other three.
Yeah.
Okay, that's perfect.
Good.
So we're gonna interview MFS, Schroeder, and Walter Scott.
Perfect.
Good presentation, Lauren. Thank you. Very
Very
good.
good, thank
Yeah,
you.
it's excellent.
Yeah, great. I'm so glad.
Perfect. So if we now want to, Britt, if you want to go to performance review,
Yes, I'm happy to. Lauren, feel free to call it a night, and thank you so much for joining the meeting.
right? Thank you very much.
Yeah,
Lauren.
you.
absolutely.
Thank you very
Thanks
much.
all.
Great job.
Have a great evening.
You too.
Okay, Frank. So we have the executive summary. It might be worth going through that since it's the end of the fiscal year. We also have the
Yep.
July flash report. So let me know if that's okay to start with the executive summary. Obviously, a lot's changed since June 30th.
Yeah. So that was that's the good one. So
Well, the July was a good month. So
July was a good month.
Was. Maybe as a start, Chitsame, she was on, I'm not sure if she still is. So Chitsame's been very busy over the summer with various items. And Chitsame, I know you sent me a great summary earlier today. Maybe if you want to highlight all of those items for the board, that'd be great.
Yeah, before I highlight all of those items, I just want to introduce everybody to Tina Fogel. She is our Chief of Human Resource Officer.
Hello, Tina.
Hello.
Hi, everyone. I'm sorry I was a few minutes late. I was in my car driving. I left the office just a few minutes too late, so I didn't want to be driving and be on camera. So thank you so much. It's a pleasure to meet you all.
Yep, thank you. No problem.
Tina, I'd like to ask a question. I got an email from someone and they wanted to join this group, listen in, and they got an ID number, but then they said they needed a password to get in.
Oh, I did get a phone call today and I provided someone with a call-in number in the web ID. I did not know that they needed a passcode as well. So going forward, we'll make sure to provide that. I'm not sure why it wasn't on the website because it is a public meeting. So we should going forward want to make sure that anyone who wants to attend is able to.
Thank you.
So I apologize for that, but I'll check into that.
Perfect. Thank you. Britt?
I'm
Oh,
sorry.
I'm sorry, Chitsame.
Thank you. I know, the last time since we met was in June, so there was a lot of items that were approved by the board, so it kept me busy for the for the next 2 months. I know one of the items we had on there was the full redemption from Blackstone. So I initiated that. We will be receiving the redemption starting in October 1st, 2022. We also had the city contribution to the pension fund, about 15 million. And out of that contribution, we sent 2 million to LSV and 3 million to Silchester. So that left us some cash that we use for the benefit payments for July, August, and we have one more tomorrow. So right now we have 10 million of cash available. We will be using approximately 3 million for our pension payments for September 15th. And so that would leave us about 6.6 million, 7 million. So with the redemption from Blackstone, we should be in good shape for the next 3 months of benefit payments. In addition,
And just, sorry, just to highlight for everyone, the Blackstone redemption, it'll take place in even increments over 5 quarters per their liquidity policy. So we haven't confirmed the exact amount that's going to be redeemed on October 1st, but we expect it to be around 5 million. So that'll booster the cash up to about 8 or 9 million after the next few months of benefit payments.
Chitsame, with the cash, are you doing anything like, say, buying 30-day CDs or 60-day CDs? Because rates now are, you can get 2% on or more, and the Fed's going to raise rates next week. So rather than, I don't know whether there's anything, because we have the funds, right, with I don't know whether it's just cash only or whether we should, since we're not going to utilize all that cash in 30 days, if we extend it out and invested it in a CD, say, for,
Yeah.
return.
Frank, it's invested in a sweep vehicle at the custodian. So it's, I think, it's basically T-bills. It is earning something.
Sometimes the sweeps are a lot less though than a 30-day or 60-day paper, much less.
Agreed. And that's something we can certainly ask the custodian on what the options are. I don't want the mechanics for Chitsame to get overly complicated, but we can certainly reach out to them and see what other potential options there are for Norwalk to invest the cash in, safe liquid vehicles.
Perfect. Thank you.
in addition, I guess there were some approval for change in fees with TCW West and also BlackRock. So we executed those agreements in August. So all the approval of what is needed in June has been completed.
And clearly I have a question to see that whether you need any cash needs, but that's been taken care of. And just as a point, after we took money from Blackstone, I got calls from Bloomberg and a few others about why did we do it? And but I never responded. I just don't want to be in the press, but somehow I don't know whether it's because the how we do the teleconference now, whether it's something that people can look up later on, but
They
that
can
was
see the meeting minutes on Norwalk's website. So
Yeah, and it's also on YouTube. It gets
Right, that's-
recorded and we'll post it on YouTube.
right. And that's at
I'm
some point, we-
surprised Bloomberg's watching Norwalk Pension Board meetings.
somebody did.
you would be
Uh,
surprised, Jim. There's a lot of people that
Yeah.
pay very close attention to all of this.
And it might be whether we as a board would prefer to meet in person rather than to continue the teleconference. This was originally designed for, because of COVID and because Britt didn't like to travel. But I don't know whether anybody has an opinion on that.
Yeah, I was actually wondering about that, knowing this stuff is public, basically, we're talking about selecting finalists here for the manager selection. Who sees that? Do all the candidates, are they all going to watch this on YouTube tomorrow and see how they fared?
Right, there should be a confidentiality also that, I mean, when you think about it, you could actually be watching you could be on the website or whatever, or logged in and watch the performance of your competition.
Right.
Basically,
And you could go into executive session, Frank. Even I know I have clients that do that virtually as well. But if we had thought it was necessary to keep anything confidential, we certainly would make you aware. I think in general, these discussions that we've had are typically public in my experience, but we can certainly go to executive session if there's ever a question or you would like to have that conversation off the record.
Yeah, I'm fine either way, but it just seems odd that when you're, you know, in a bidding situation that all the bidders can watch the process. It's kind of unusual.
Well, we're a public
Yeah,
facility, so
Yeah, I understand.
having open bidding's not a bad thing.
Yeah, I agree. I'm
But
fine with it.
people, you know, as far as the you know, having the meetings in person, I'm personally fine with that, but I would like to have the flexibility to do it virtually. You know, for example, I am not in Norwalk for, you know, at least 2, if not 3 meetings a year, and I still want to, you know, and those meetings are, we have, you know, and that's 30% of the meetings if I miss 3. I don't want to. I think I have a responsibility to do more than that, and if it's virtual, I can do that.
Yeah. I think the city was kind of wrestling with the technology issues of having meetings that are hybrid, you know, in person and virtual, right?
I don't know if they've solved those or not yet.
Yeah.
Last night's common council meeting was both. There were people in person as well. And so if that is something that you'd like, we absolutely can do that so that we can accommodate both, you know, the individuals who would like to be in person as well as those who would want to be virtual.
Yeah, I remember that they converted a number of rooms, and it's in addition to the common council room. I think they might have converted the room that we traditionally used up on the I can't even remember whether it was the 2nd or 3rd floor.
Actually, that room, it was converted to an office for our Board of Education. So we do not longer have that 3rd floor room anymore for the pension meeting.
So where would they put us?
We would have to schedule a different meeting room that would be available for the date of the meeting.
And do you know if there'd be a hybrid room available?
I've heard that the only current hybrid room is the Common Council Chamber Room. They are looking to get the smaller meeting rooms to set up the equipments to make that a hybrid meeting accessible type of room.
Okay.
At one point, a while ago, when I was trying to have some discussions with the city, they offered us the possibility of using the run room that is now wired, you know, the city council, where the city council meets, but I think the city council also meets on Wednesday nights. Right? I think they meet tonight. I'm
Tuesday.
not certain of that, but I think they do. So that obviously would have been crowded out, but
Yeah.
anyways.
The
They
other
actu-
alternative, Frank, is to move the meeting time. That, you know, I have a lot of clients that meet at various times throughout the day, so just an option.
Okay. All right, I just wanted to, we could go back now. Chitsame updated us on what she did. Thank you very much. And then we're gonna go back.
Great
to
job.
Rick.
A lot to do.
And by the way,
Yes.
one other thing, there's nothing in private equity, no money in or out or capital calls or anything.
I
Thank you.
haven't seen any capital calls that I'm aware of. I'll highlight the cash flows that we've seen from private equity when we go through the executive summary.
Excellent. Thank you.
Thank you, Chitsme, for doing all that. Very helpful and important for the pension. Would you like me to share my screen, Frank, or does everyone have it up?
Either way.
Okay,
You could
I'll reference PDF pages for the executive summary.
Okay.
We'll just start on page 4, just giving a market backdrop, for the time periods ending 6/30, which is the end of the fiscal year. And as you know, the war in Ukraine continued to slug on. We've seen inflation be extremely persistent and actually increasing across the country. The Fed's raised rates and will continue to raise rates. COVID spiked again, and we certainly saw abroad in China some COVID zero policies which hurt their economy, which really played out in emerging markets. Long story short, you all have seen it. It's been extremely volatile. Equity markets down almost 20% through the first 2 quarters of the year. They did bounce back pretty significantly in July, but August has been another volatile volatile month. The energy markets, as Lauren highlighted earlier, have certainly been one of the few positive performers within equity markets, as well as utilities. In that flight to quality and income within the utility sector. Value outperformed growth significantly in the first quarter and for the start of the second, and it really swung back the other way towards the end of the quarter and in July, and in August we've seen the opposite again. So it's really been hard to pin down what is driving style and really it's sentiment, and continues to be extremely volatile. And given the inflation and Fed rate hikes that we've seen, bonds were down significantly. You can see that, well, typically we would expect fixed income and equities to be far less correlated. It does happen in markets where they're both down at the same time, about 10% of quarters over the last 100 years. And that is expected to continue as rates continue to rise. I think the one positive outlook, certainly for pension systems, is that means that yields will go up going forward, which is certainly helpful in trying to achieve your discount rate. So given that backdrop, I will jump ahead to page 19 of the PDF, highlighting the actual asset allocation versus the target. You can see really most of the underweights are domestic and international equity, really driven by the first 2 quarters of the year and down markets within equities. Overweights are PIMCO All Asset, which is really the real return and helps hedge inflation. So that's positive. Your absolute return manager, UBS, is overweight. They've done very well through the first 2 quarters of the year. And private equity, just given the lag in reporting, we haven't seen those valuations come down yet. They will. We probably will start seeing that pretty significantly in the 3rd quarter reporting when private equity valuations come down to some degree in relation to public markets. We turn ahead to PDF page 20, just showing the cash flows to Frank's point. You can see within private equity under the net new investment column, really we're seeing distributions come out of most of the funds. You can see that the first 4 or 5 really are at the late stages of their life. The Global Secondary Fund has $60,000, really tiny amounts, and the Pantheon US Select 4, which is the bulk of the exposure, is also making distributions as it is pretty mature at this point. So no capital calls to your question, Frank. Total assets were about $455 million at the end of the quarter. You can see most of that being driven by unrealized investment losses. We turn ahead to page 21, just showing the targets versus, showing the asset allocation versus the target, as well as the ranges. Everything's within range. You can see total equity is underweight, but only by about 2.5%. And most of that is, as I said earlier, is in public US and public international equities. You're slightly overweight global equity long short, As Blackstone will continue to liquidate, we will revisit candidates. We were hoping to do that at the November meeting. If that is okay with the board, we are evaluating both direct and fund-to-fund managers and hoping to bring a short list for consideration in November. And then finally, just highlighting the UBS and PIMCO overweights, but everything's within their target range. And then page 22 and 23, we have performance. I'll highlight the trailing 1 year, which was the 2022 fiscal year for Norwalk. You can see the last 2 quarters certainly hurt returns significantly. I think the good news is broadly, your active managers have performed very well. LSV, who, as you know, struggled for a number of years in that growth environment, outperformed their benchmark by over 10% for the trailing year and continues to perform well since the second quarter. And Columbus Circle outperformed. They did underperform for the quarter, but you can see their extremely good performance coming out over the 3, 5, and 7-year periods. Artisan in the second quarter had a good quarter in an environment where their GARPI approach was in favor. They did outperform for the trailing year as well, but longer term continues to struggle. And Silchester also provided some downside protection in both the quarter and year. BlackRock has struggled. I think a lot of their relative underperformance has to do with some of their China plays and China bets. As you know, this is a pretty sophisticated quantitative strategy that has a lot of moving parts, but we've seen, the COVID zero policy in China really hurt their economy in 2022. Within global equity, you can see ABS and Blackstone did diversify your beta exposure, your equity beta exposure down about 5 and 6% for the quarter versus, down 16.5% for public US equity. Again, still negative. Longer term, ABS continues to do well. And then on page 23, highlighting fixed income managers, in the rising rate environment, both of your active fixed income managers underperformed, mainly due to some of their exposures to the plus sectors, which is higher risk, more things like high yield bank loans, out of benchmark exposures that over the long term we've seen perform well, but they did not outperform for the trailing year. UBS, your absolute return manager, had a great trailing 1 year, up almost 8%, when public equities were down, over 10 or over 14%. So great to see that diversifier continued to do well. And PIMCO, while they were down about 9.8%, they did provide some diversification within the portfolio. The US TIPS benchmark is really not representative of what is under the hood of that fund. As you know, there is traditional bond exposures, traditional equity exposures, as well as their diversifier bucket, which is really seeks to hedge inflation. We had a call with the chairman of the strategy and his team last week. And it was interesting to hear from them, and they think that they're positioned to do extremely well in the next 5 years, given this market environment and the inflationary pressures that we're seeing. So we'll continue to keep an eye on them. So overall, for the fiscal year, this includes delayed or lagged private equity numbers. Total fund down about 12%, really in line with the benchmark. Longer term, returns are a little more muted, but no concerns in terms of the active managers, and really most of them have done very well, and relatively speaking, in a volatile market.
Chitsame, would you know whether they're gonna move the discount rate down to 6 5/8, 6 3/4?
Yes, I believe that was the plan to get to 6.5. I don't have it in front of me. I just saw the July 1st actuary report. I'll get that to you later.
Thank you.
Yeah, I
And
thought
Chits
we're
may-
doing a quarter, 25 basis points a year, right?
Yeah, I think it was an eighth of a
1/8.
percentage
Oh, an eighth,
point.
okay.
1/8.
Chitsme, if you could send that to us as well, just to review, we can update the reporting going forward as necessary.
Okay.
So that's all I had in terms of performance for the pension. We do have the July flash report as well. I'm happy to go through that. I don't think anything in there is startling. It is a little brighter picture. Just to put in perspective, the S&P 500 was up over 9% in July. Growth significantly outperformed value, and fixed income was up over 2.4%. So while August is again down, we did see a bounce in July, and from our perspective, we would expect volatility to continue, certainly in the immediate and short term.
And we do.
In July, Blackstone did underperform again, big time.
What'd you say?
Blackstone was up 0.89% with the S&P index. That's their benchmark. It was up 9.2.
Well, that's not the
Is
most
that what's
fair
called
benchmark
upside
for them,
capture?
but-
Any other questions for Britt?
No,
Okay. Is there any possibility that, Jerry, are you still on somewhere?
I had just emailed her to see if she was still on. I haven't gotten a response yet.
Okay. Then one of the things, hopefully we can get back to get Jerry back and we can go over the pension applications. One of the things before that, though, I have been in contact with the city because our contract with Callan expires, I believe it's May of 2023. And I spoke with the purchasing and control services person, Ms. Connors, about us maybe possibly having the contract extended. They decided that because we've already extended once, that we should have it go out to bid. It's not a negative reflection in any way in Callan. I think that I will speak only for myself, but I personally have been very satisfied with their work and their commitment to us. So my understanding, Charlie and I, right, Charlie, we did it the last time
I
in
think
the
so.
search, right?
Yes.
And the process was kind of, they'll put out to bids to a number of individuals. And after that, the city will kind of whittle it down to perhaps 5. And then they will be interviewed by board members. And I would like people, if they are interested in participating in that, if they sent me an email to confirm that. And then that would work a way down to maybe 1 to 3 that we could meet with the board, because this is it would be another 5-year contract. And then ultimately, though, the board votes on who they would like to select. Each time that we've had a vote, as long as I've been on the board, it's been unanimous. I do think that Callan, I hope that they will apply, they will be notified and apply. But I wanted to let everybody know that that's the case. it would, because the process does take a number of months.
When would this start, Frank?
I would think they will probably send out a notification probably by next month. And then after they usually, I think, give maybe 60 days to respond to submit proposals. And I would think that probably in January, hopefully by January, February, we're interviewing to go in front of the board to have the board decide.
Does the city know enough about what the advisor role, consists of to develop a meaningful RFP?
I do think so. I think the last time the potential firms that Charlie and I interviewed, I think they were all pretty capable. So they've done a good job with that.
Okay.
I have faith that they'll do well. I mean, I worked with Ms. Connors in regards to finding a new actuary.
Mhm.
And I found that she did an excellent job. I felt that way.
Okay.
Okay. So anyways, hopefully we'll see Britt, because, and he knows how we feel about fees. So you already have an inside track.
Well,
Anyways.
we will certainly would love to continue the relationship and totally understand the fiduciary need to go out to bid and fully support that. And any news on the issuance of the RFP, just to make sure that we're aware, would be appreciated. But we fully intend to participate and certainly want to continue working with you.
That would be wonderful. If Jerry have you heard from Jerry?
I just texted her. She said, I'll try again, stand by. So I'm
Okay.
hoping she'll be on shortly.
Perfect. Then we could just table this meeting for now and move on to the very short OPEB meeting.
Mhm.
Okay,
I move we table it temporarily till we can get Jerry on the phone.
excellent. And I'm sure there's a second to that.
Second, yep.
All in favor? Aye.
All right.
Excellent. So we are then going to move on to the OPEB meetings. So I would like to call to order the OPEB meeting of September 14th and move for acceptance of the minutes of the last meeting in June.
I didn't see any problems. I move we accept the minutes.
Is there a second?
I'll second that.
All in favor?
Aye.
Opposed? No. Rick, you want to quickly
Sure.
go over?
Happy to, Frank.
performance?
So I'm also going to refer to the executive summary for OPEB. If you turn to page 31 of the PDF, show the asset allocation versus target. Everything's very close to the target allocation, slightly underweight international and slightly overweight domestic equities, fixed income, and liquid real assets. But everything is well within the target range. On page 32, just showing total assets of about 117.6 million. You can see some unrealized investment losses during the quarter, given the volatility. And then I'll highlight performance on PDF page 34. As you know, the OPEB has a little higher public equity exposure than the pension, mainly invested passively through the Vanguard funds. And you can see that really drove total fund performance. So it was down about 14.3%. Slightly worse than the benchmark. As I mentioned, in the pension, your fixed income managers, which are the same here, underperformed for the trailing year, but longer term have still performed well. And really the relative underperformance was being driven by PIMCO and more of a benchmark mismatch than anything, because the TIPS index is so much more conservative than the actual portfolio. So overall, no concerns with the OPEB.
Should we consider changing the benchmark for PIMCO?
So when we met with them last week, we gave them a very hard time about the benchmark. Because, you know, their goal, I guess their aspirational target is CPI +5, which is not an investable index. Their mutual fund stated regulatory benchmark is the TIPS index, which is why we show it in the reporting. I think, so Tom and I were talking about this quite a bit. And we do think there should be a secondary benchmark of some sort. This strategy, as you know, has equity exposure, it has fixed income exposure, it has all kinds of different things under the hood. So maybe that's something we can revisit at a meeting or two. And I'll discuss it internally with our research groups to see if there's something that we can put together to really try and put it into better perspective. I think the policy benchmark should probably stay the TIPS index because that is technically their stated bogey and they do beat it over time. But in the short term, there will be noise with that benchmark.
Thank you. Any questions regarding OPEB?
No.
Motion for adjournment?
Move to
OPEB
adjourn.
Is there a second?
Second.
All in favor?
Aye.
Aye.
I believe Jerry.
Nope. Okay, and now, no problem. Now we're gonna go back to the regular meeting and hopefully Jerry is available, possibly.
Well, I hope I am. Can everybody hear me?
Yes.
We can hear you loud and clear. Perfect.
Sounds much better.
Okay,
All
we're
right,
gonna
then I'll
go,
dial it. You can hear me loud and clear. We won't want to be too loud.
right. Well,
Are we
we
gonna
are-
put the,
We're gonna start with the regular meeting, the 6 pension applications, because we're still right now in the pension board meeting, the regular pension board meeting. Not the
No problem.
service, okay?
no
Perfect.
problem. So we'll go to the regular pension applications. First one is for Jill Giuliano, Board of Education Secretary. She is electing, or has elected a regular pension. She elected option 3. Her monthly benefit is $386.77, annualized to $4,641.24. Second one is Philip Sanat, Maintainer 3 with Department of Public Works. He also elected or eligible for a regular benefit. He elected option 1. His monthly benefit is $1,949.58, annualized to $23,394.96. The third one is Lizette Tuccinardi, Special Ed Aide with the Board of Education. She is eligible for an early retirement. She elected a normal form of payment. Her monthly benefit is $792.80, annualized to $9,513.60. The next one is Francis Wilk, Engineering Aide 3, also with DPW. He is eligible for a regular pension. He elected option 1. His monthly benefit is $4,783.33, annualized to $57,399.96. And then the fifth one is Michael Devaney, Telecommunicator 3 with the Police Department. He is also eligible for a regular pension. He elected option 1. His monthly benefit is $2,935.90, annualized to $35,230.80. And then the last one is Marianne Carriera, our Secretary with the Board of Education. She's eligible for an early retirement. She elected option 3. Her monthly benefit is $1,280.64, annualized to $15,367.68.
Are there any questions on any of the pensions? I
No.
did review them and I did communicate with Jerry on one point and everything was fine. If there's no questions on the pensions, would somebody like
Then I
to,
move we accept or approve all 6.
is there a second to that?
I'll second that.
All in favor?
I,
Aye.
Aye.
Opposed? No. Excellent. Thank you, Jerry. I'm going to move to adjourn this meeting and then go back to for a moment, the food service. Jerry, so is there a motion? Is there anything else that anybody would like to bring up or for discussion at the regular pension meeting?
Just, Britt, what are the next couple meetings? Any particular topics coming up?
Yes, so in October, we will bring in the 3 managers to interview. And we also have a DC meeting. So Callan is working on a record keeper and investment manager fee analysis that we plan to present. And then in November and December, we have a couple of things. One is to review the candidates within Global Equity Long Short to replace Blackstone. And the other is on our work plan is the OPEB asset allocation review. Not so much that there's anything wrong with the OPEB asset allocation, but every 3 years or so, we certainly want to revisit it and make sure that the board is comfortable with the target asset allocation of the OPEB. So we'd expect that in December. And the Global Equity Long Short candidate discussion and next steps we're still working with our research team to see what is feasible in terms of that discussion. So as soon as I know more, I will let the board know, but I would anticipate November, December for those.
Is the DC presentation going to be performance or what else in that? Any records?
So it's really a market review of Empower's services and their costs. So one, benchmarking their fees versus peers to make sure that what they're charging the city for the DC plans is reasonable. And 2, evaluating each of the investment options and their management fees and expense ratios and making sure, again, that they are competitive versus peers. And if there are any cheaper vehicles or share classes available that Norwalk is aware and can move into those. So it's really reviewing administrative and investment manager fees.
Okay.
Jerry, because we have you here, have you had any people responding to you about Empower in a positive or negative way?
All positive. They are operating as a very well-oiled machine. We've got new enrollments going into the 457 component of the DC environment. So it's all good news, Frank, to give you a snapshot.
Excellent. Thank you.
Sure.
Any other questions or discussion? And if not, we're moved to adjourn again. And is there a motion to adjourn? Second, all in favor? Aye,
Aye.
thank you very much. Okay, we're going to now reopen the Food Service Committee meeting. And the minutes that are from October 13th, I was at that meeting. I read over the minutes. They're fine. There's really, technically, everybody can stay and be on the committee if they would like. Usually there's only like 2 people, and usually the union president, Mr. Browning, is here. However, I don't believe he is at the meeting. And the food service meets very rarely. The minutes are from October 13th of last year. And at that time, there was 1 pension. So in 11 months has been only 1 pension. Today we have 3. And I think that if you just reviewed those 3. Please.
Absolutely. The first one is Lyle Gardner, manager. He is eligible for a regular pension. He elected option 3. His monthly benefit is $1,713.38, annualized to $20,560.56. The second one is Evelyn Sear, cafeteria worker, also eligible for a regular pension. She also elected option 3. Her monthly benefit is $704.76, annualized to $8,457.12. And the third one is for Hollis Wilson, also a cafeteria worker. She is also eligible for a regular pension. She elected the normal form of payment. Her monthly benefit is $243.07, annualized to $2,916.84.
Thank you. I
You're
did
welcome.
I reviewed all these. I didn't see any.
Yep, I didn't
Problems.
see anything, so I move we approve all 3.
Excellent. Any discussion? A second? I'll second that. And I think technically Charlie and I, Jim, I don't know if you're on the food service. Meets
Yeah,
very,
I think so.
I think,
Yes, I
I
think
think so.
you
I reviewed them also. I'm fine
Yeah.
with them.
okay, so all in favor, meaning Charlie, myself and Jim, I
Aye, aye.
oppose. Okay, no, thank you. Motion passes. Any other discussion? If not, is there a motion to adjourn? Thank you, Jim. Is there a second? Thank you,
Second.
Charlie. All in favor?
Motion to
Aye.
adjourn.
Have a great night, everyone.
All
All
right.
right,
Thank you very much, everybody.
Thank you.
thank you.
Thank you.
Thank
Okay.
Joe will
Thanks.
Good night.
approve.
Bye, yep.